Right, yeah, important thing for tomorrow, and it's the May Fed meeting. So yes, it's really the potential for the biggest rate hike since the year 2000, um, and it all has a big effect on everything, not just what happens in America, what happens in crypto, stocks, shares, bonds, the wider world, general economy, all sorts of things. Um, so, yeah, I mean, going back to COVID, consumers saw a Federal Reserve willing to pull out all the stops for monetary policy during the coronavirus phase. So monetary officials really got stuck into revive an absolutely hammered economy where everything was shut down. People were, they just needed a stimulus in there. They put the stimulus in there. They started printing money. And as a result, there was a lot of buying, a lot of confidence instilled back into the market, and stocks jumped up. Retail traders got really stuck in as well. Um, and also affected the cryptos. It was a really good boost for crypto coronavirus time. Now, um, the same organisation, the Fed, known as the Fed, um, i.e., the Federal Bank, the Federal Treasury, the building there is where they are. You may have seen it before in Men in Black. It was used in Men in Black as a Men in Black HQ, little thing there. So the policymakers is a FOMC meeting, and that means the Federal Open Market Committee. And that committee is expected to raise the interest rates by a considerable amount, far more considerable than usual. 0.5% doesn't sound a lot, but in economy terms, it is, and it's not happened since the year 2000. So tomorrow and the day after, May 3rd and to the 4th, it's a rate set meeting. Um, and it's a pretty big magnitude, the biggest magnitude since the year 2000. The expected bump breaks from the previous tightening cycles. Tradition, the tightening cycles. What's happening? They're trying to tighten up on the money going out on that quantitative ease. So it's a quantitative tightening. And what they're going to do, have a series of meetings over the year. They're going to be trying to tie quantitative tightening of that money supply. And they're going to, and they want to arrest or just put the brakes on the, all the inflation, which is whopping. It's like 8% out in America, so it's absolutely whopping percentage. Everything: food inflation, fuel inflation, heating inflation, medical inflation. The whole general cost of living inflation for business. It's the supply inflation as well. People looking for higher wages. There's logistical problems and inflation there as well. Prices of absolutely everything in manufacturing is going up, and it's not just the consumers. So, it's the first time in about 16 years that officials have hiked up the borrowing costs upon back to back gatherings, back to back committee meetings. Um, 20 back when was that? 2017, haven't we? And back in March there was a quarter point rate hike. So there was a 0.25% rate hike back in March, and the markets reacted positively. Actually, went up a little bit in a way. It did come down. There was a lot of fear about it. Thought it was going to be a bit harder, but it showed it's serious. The markets were showing is serious about the Fed's serious about tackling the inflations. So They so ooh, so yeah, they've got what they have. So it's about the bonds, U.S. central bank and the bonds. They got a 9 trillion bond portfolio, and they're looking to reduce that at about 95 billion a month, right? So on the books, they got 9 trillion bonds and 9 trillions worth of bonds, and they want to reduce that 95 billion a month, right? So that was set back in the March meeting by those by the Feds. If that is so, that is probably about twice as rapid rate as the previous time those people, that organisation, looked at trimming the money supply back in 2017. Yeah. So um, the experts reckon that move could just put the zap on more stimulus from the financial system. It's trying to stimmy that stimulus, quantitative tightening. So what that means is it's going to be higher mortgage rates, higher mortgage costs, higher long-term borrowing rates for the consumer, and that's also those higher long-term borrowing rates extend to business too, banks and the wider manufacturing area and the service sectors too, right? Um, and that affects investments and all sorts of things. There's an absolutely roiling inflation at the moment. Heavy inflation, really hot at the moment, and there's prices of everything. Is I think that's about a 40-year high in America. So that's 8.5% on a year ago. 8.5% on a year ago. So that was higher than the desired estimate or the desired level for the federal bank. So that is really impacting on monthly budgets and everything. Um, that's everyday costs, plus their mortgages, plus that's their sort of monthly expenditures. So food, fuel, energy, rent, but also for the higher purchasing stuff. So the consumer market is going to be tightening as well. Not so much spending on things for around the house and the like, holidays or whatever, buying on finance, um, and even buying outright. Consumers are going to see a much more aggressive sort of approach from that US central bank further on in the year. Um, and it's who's that? And then so 0.75, so 0.75% increase is there for June, which is on top of what's already there. It's more tightening, yeah, and the that quantitative tightening continues to stiffen because they're looking to get it done in a year's time. So this time next year, they want the rates that inflation tightened down. They want it tightened down, um, and I think that's the biggest move since 1994, and it's I think possibly the second of its kind. Rising interest rates are not going to be the main factor. It's going to be measured in like real percentage points by the time it's all said and done. So the ultimate effect of what matters, pardon me, the cumulative effect, yeah, accumulative effect, I can't say, um, is what matters, and it's just that effect which accumulates and rolls in over time, and it's going to be a pretty hard and rapid clip around the back of the ear of not just inflation but everyone really, and the markets in particular. Um, so yeah, looking for that half point hike, that 0.5%. So yeah, there's some. The chairman, I think, of that bank, he wants a much more aggressive rate hike. Apparently, just reading through the news, reading his statements. Um, but moving faster would perhaps move it for the Fed to move faster. Um, it might just be a sort of short, sharp shock, but they don't want to dangerously restrain growth. All right. Um, so it might just be absolutely hard because they want to come out of the gates quite fast and really act on it, really get to grips with it quite quickly before it gets out of hand. Stocks plummeting and all sorts of things. So that's the main interest in the stocks. And the stocks are coming down because there is the knowledge that there's that massive inflation and the squeeze on the consumers, and that in turn affects the stock price because that affects the income of those and the values of those, and return of investment for those companies and their stocks. Um, so normally they do sort of quarter point type of 0.25% increase. But they're going hard and then they're going to back off. I think that's the idea. It's going to shock the stock market with a bigger increase, but it's going to shorten the duration of the accommodation of what's happening. Um, it's just reducing the time frame. So they're accommodating the fact that they need to get this done quickly, and to reduce the time frame for what's happening is what they're going to try and attempt. So there's short, sharp shocks rather than dragging it out. Um, and they're looking to get it back down to 2.5%. I hope it works. I really do. Um, but this has happened before, so in a way, so the Fed Bank has acted before over history, to curb the enthusiasm of the stock market, not allowing it to get carried away by pinching on those factors on those factors which affect the stock markets. They've allowed it to pump up, and they've also cut out those things which stimulate and allow the stock market to get carried away. Yeah, it is manipulation, but it happens and it's done. Perhaps happened frequently over history. Um, so by the end of the year, right, the financial year that is, so April, yeah. So really, they're looking in March because the March meetings happen before the end of the financial year in April. So it'll be mid to late March early to mid March when they have a series of meetings, and that's when they're looking to get those rates closed, those interest rates close to 2.5%. That is their goal, close to 2.5%. Um, but they're not going to be able to do that on doing 2.2 a quarter percent, a 0.25, that quarter point pace. So they've got to do it sharply to get there. They've been set their target and they've got to get there. They don't want it dragged out. They don't want that economic fucking disasters, all those red candles on the charts, they don't want that dragged out by doing this too many 2.5%. Just be fighting a cold with cold. It's just like standing in the cold, whilst having a cold and having just cups of tea while stood in the cold. You need to get in the right place for it to fix it, to get better, because it's a bit of a sick economy. They got a big balance sheet there, and they want to trim the balance sheet as well. Um, so the Fed's balance sheet is massive, and it is another major effect on consumer borrowing costs. So the drawdown impact could be even greater than the rate hikes as well for the consumer. Um, it's a bit of a funny edge of that policy, but um, just shrinking the availability of money in the financial system, and they're going to trim the portfolio of their securities, and those assets include sort of longer dated treasuries and mortgage-backed securities, and shorter term bills. Um, so those things, those yields there, they're an important consumer borrowing cost benchmark. So getting those mortgage-backed securities and the shorter-term bills down is a key thing there. Um, so loans going out at sort of varying maturities, that's the timeline, could be impacted. But how much the Fed suppose, there's about, nearly a trillion drawdown, well, that 95 billion drawdown, um, could influence the borrowing costs. It's going to depend on demand. Um, and, I can't really fully realise all the mechanics of all that, considering the markets have only one other experience with such a program, um, of quantitative tightening back in 2000. So it's only the second time. It's still new. So the markets, because it's not familiar to the markets, no one really. There's not really a back test for it, a reliability. There's not the same reliability of the timeline which the Fed has set for a year's time. So essentially next March, really. Um, so you got the Treasury yields are, and the 10, well, an example, like the 10-year Treasury yield has climbed, 1.2%, right? Um, so the Fed is one of the biggest sort of buyers around there. So if those big buyers step away, then, who knows what's going to happen, because it is something that makes the economy breathe a little bit. So if there's less money sort of around, less liquidity about, there's going to be perhaps less activity, with higher costs of borrowing, higher costs to gain that liquid capital to invest, and that is going to sort of stimmy things a little bit, and that is the restraint that they're looking for, and it's a pretty significant restraint as well. Um, it's perhaps not clear, but it's they're being serious about it. Um, there's what else is there? What else have I got here? Um, yeah, so definitely it's going to be a tighter pinch on the mortgage rates. Um, costs of financing a home, for example, is jumping. Um, there are bigger spikes which have happened, but the rate of speed of these sort of spikes are just not really happened before. Long term rates, the borrowing rates, the long term borrowing rates, long term mortgages, for example, apparently they tend to move faster than the central bank. This is because it's like where investors expect the financial system to head over the life of that loan. Um, and so, well, yeah, yeah, and those costs are right because in the near term, over the next year or so, the Fed's going to be aggressive and put those rates up. So businesses have basically anticipated, or lenders have anticipated the increased cost of borrowing and are already transferring that over to their customers. The customers are going to have to pay higher rates to make up the difference that the business would lose because the percentage is going up for interest rates from the Fed. Um, so yeah, the life of that security is well affected by the Fed's actions of increasing the percentage rates there. Um, Cooling inflation could prompt. Wants to see that cooling inflation. Expect to see the Fed to step back. But there's that worry that might see a slowing of it's that cooling off of inflation, but also um, the sort of slowing of the economy as well. It's a mixed bag, isn't it? And that's going to affect all the prices. So it's a bit of a funny one. The market could react in different ways, can't it? You know, yes, people are already worried about recession. But as the Fed gets more aggressive, more hawkish, more people are sending out that message that some sit seriously up, and the recession worries grow. But we know that anyway. If they're not doing something, they can't do it. But you know what people are like. Every market reaction is an overreaction. So whatever happens tomorrow, it's going to be a big reaction. And if the news is positive, if the markets regard the news as positive, expect to see a nice pump tomorrow, the next 2 days, and the reverse might be true. Expect to see some red. You know, there's lots and lots and lots of challenges to get those interest rates at the right level. Dealing with inflationary supply chain bottlenecks. They've got to deal with corners of the economy they can't directly influence or fix by rising the interest rates, but they still somehow got to get there. Um, you know, the the both domestic and global productivity, the capacity to produce is still lower than it was in the pre-pandemic because of those supply chain bottlenecks, all the costs and supply. Oh, it's a nightmare. Um, so whacking up the interest rates and therefore the costs and all that sort of thing is going to affect that. Its cost of sorting those problems out are going to increase. So it might take some steam out of the economy if they get it too wrong, if it goes wrong. Um, the higher the rates climb, the faster the economy gets slowed, making it becomes an even more complicated job, perhaps. Um, you know, rate hikes apparently, it comes with a bit of a lag, but it after a while. So whatever happens there in the big business side for the banks, cost of borrowing for the banks, it takes months and many months to have that knock-on effect. It doesn't just happen straight away, and so they want to make that they want to make the exit of that inflation. They want to exit the room. That people don't think it's just going to be a quick, oh, that's what it's going to be like straight away. No, it takes time to catch up. There's a strong lag there, and the labour market and all that sort of thing will affect them months down the line. So yeah, you've got to be careful about it. Um, they could do too much or they could do too little. They could slam the brakes on an economy, or they could even really add to what is already a recession with stagflation and all kinds of stuff going on in there. Um, that you know, whatever happens, it's got to prepare for a slowdown. Um, People need, it's like people are going to be looking at bolstering their emergency savings, making savings all around the lane. And there's going to be refinancing going on. And there's already things like, Netflix. People are stopping their subscriptions and taking that monthly money and putting it probably into those emergency things, putting it into trying to find long term money for long term savings to keep those going. And people are having to really, really, really scrape at the moment. Um, but we shall see. We shall see tomorrow. But yeah, that was my little diatribe. But yeah, always living and learning, and that's what I've been looking at for the past month or so, past few months. So there we go. Um, Not a very confident reading, but there we go. I could barely read